In this video, we're going to be performing a deep dive on Target's dividend safety. To begin, let's talk about Target's business model. Target is one of the largest retailers in the United States. The company was founded in 1902, and today, its business consists of 1,850 discount stores which offer both general merchandise and food. Target trades on the New York Stock Exchange with a market capitalization of $37 billion. Target is a well-known dividend stock because of its compelling track record of dividend growth. With 50 years of consecutive dividend increases, Target is a member of the Dividend Aristocrats, a group of dividend stocks with more than 25 years of rising dividends. Target's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. Because of this, Target is not just a dividend aristocrat but also a dividend king, a group of even more exclusive stocks with 50-plus years of dividend growth. Looking ahead, the potential effect of e-commerce competition has led some investors to question the safety of Target's dividend. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Target's dividend safety in the context of the company's current earnings. When Target reported third quarter financial results on November 20th, the company reaffirmed its financial guidance for the full fiscal year. Target continues to expect to generate adjusted earnings per share between $5.30 and $5.50 for the 12-month reporting period. For context, Target currently pays a quarterly dividend of 64 cents per share, which implies a full-year dividend payout ratio of 47% using the midpoint of the company's current financial guidance. Using earnings, Target's dividend is very safe for the foreseeable future. Many analysts believe that comparing a company's current dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Target's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Target generated $3.6 billion of cash from operating activities and spent $2.9 billion on capital expenditures for free cash flow of around $700 million. At the same time, Target spent around $1 billion on dividend payments. This implies a free cash flow payout ratio of 133%, which is clearly unsustainable over long periods of time. With that said, Target's year-to-date results were simultaneously impacted by a large increase in its inventory account, which reduces cash flow from operating activities, as well as higher than normal capital expenditures. The cyclicality of Target's operations around the holiday season means that looking at full-year financial results is a much better way to assess its dividend safety. Accordingly, we can turn to Target's 2017 results. Through the full fiscal year, Target generated $6.9 billion in cash from operating activities and spent $2.5 billion on capital expenditures for free cash flow of about $4.4 billion. At the same time, Target paid $1.3 billion of dividend payments for a free cash flow dividend payout ratio of 57%. On the surface, Target's dividend safety relative to free cash flow appears alarming if we assess only its year-to-date financial results. However, measuring its dividend safety over a longer period of time, i.e. fiscal 2017, reveals that Target's dividend is safe for the foreseeable future. Companies do not cut their dividends during the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Target's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Target's performance during this time period is shown below. Target performed very well during the last recession. Although earnings declined slightly, they rebounded to a new high in 2010. Accordingly, we have no concerns about the company's ability to pay rising dividends moving forward. The last angle that we will use to assess Target's current dividend safety is by looking at the company's current debt levels. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. In Target's 2017 10-K filed with the Securities and Exchange Commission, the company reported a weighted average interest rate of 4.1% on its outstanding debt of $10.4 billion. This implies aggregate interest expense of $426 million. The following image shows how changes to Target's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow reported in fiscal 2017. As the image shows, Target's weighted average interest rate would need to increase above the 25% level before its interest expense would reduce its free cash flow enough to endanger its dividend. Accordingly, we believe that Target's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Target's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.